Right now, the real estate market feels completely broken. But what if that's the biggest opportunity smart investors have seen in years? Today, we're going to show you exactly where we are in the cycle and why so many deals are blowing up, and why investors are able to buy the same property for 20 to 30% less than just a few years ago. My name is Dan Breezy. I was a professional snowboarder, transitioned to full-time real estate investor. We currently have 3,300 units under management, 450 million of assets under management, and 190 million of equity under management. To understand what happened, we got to go back from 2012 to 2021 and look at this ramp up period, a major cycle expansion period. From my experience, what happened in 2012 was we came out of this beautiful recession, right? It was painful, the great financial crisis. I was still middle of my snowboarding career. And in 2012, the market started to bottom and it actually started to heal itself. And my timing was so lucky. You know, I'm in my snowboarding career looking to invest some capital, and I start buying in 2012, complete luck. And I'm putting capital to work on different assets. I'm buying a duplex, I'm buying a nineplex. And as the market is bottoming, we start to come back and we start to see rates dropping. We see inventory kind of flat, and we just see a lot of pressure on rents over a long period of time. And so we see this period of basically the real estate cycle resets, and it gives us this opportunity from 2012 to 2021. It wasn't straight up and to the right. There was some pullback, there were some interest rate adjustments, but generally speaking, what happened is we had interest rates coming down. We had a strong supply imbalance. Rents were going up, inflation was solid, and it allowed us to have really, really consistent NOI growth. And that NOI growth has driven values immensely from 2012 to 2021 until everything popped in 2021. So what ended up happening in 2021 is, as you go back from 2017 to 2021, let's just do a shorter time period, deals are turning. You're buying a deal, you're selling it 2 years later for 150% gain. You buy another deal in 2019 and you get another 150% gain. Then 2020 hits and COVID comes in, and all of a sudden they ramp up the money printing machines and they start to print like they have to, right? The world shuts down, everyone's freaking out, and they start sending out checks. We also got checks in the mail for free. And that lit a fire on inflation. That lit a fire on rents. And it wasn't just our industry. Like, I remember going out and looking to buy a Can-Am Defender, and they didn't have any. They couldn't get them here. And if you wanted them, they're like, you got to pre-order, give us 10 grand right now, and we'll tell you in 2 months when it shows up. Otherwise, you can't have them. And so there was a huge supply-demand imbalance with a massive amount of currency printed into the market. And while that's happening in the real estate side, specifically multifamily, we're buying these deals, exiting, buying these deals, exiting. One of our deals we ended up buying in 2019, and an investor put 300 grand in, and in 2021 we exited and gave them 900 grand back. And so what happened is you've got these investors who are now saying, hey, awesome work and thank you, but I got a capital gains problem and I need depreciation, Dan, or the government is going to come in and take a lot of my gains. So as the investors had so much momentum from 2012 to 2021 and kept winning and kept compounding, it just turned into this frenzy. It's kind of like a FOMO. Inhibitions thrown to the wind. You already doubled my money, tripled my money. I don't want the capital gains tax bill. Please find me another deal. And so that's where we were in the market. And when interest rates dropped during COVID, it also accelerated asset prices. And so you just had a really long window where people didn't lose. So the idea of losing was out the window. It wasn't around. It didn't happen anymore. It just was real estate goes up and it compounds aggressively. So people started to underwrite very aggressively. 7, 8, 9, 10, 12% rent growth. Like anything over 5 is insane. Even now, 5%, like you're not putting 5% in there. You're putting 2.5 to 3% rent growth, 3 to 4% expense growth. And that's the way it is, in this market. But back then, 7, 10, 15% rent growth. And that's how you made deals work. With very, very low interest rates, allowed people to overpay for deals. And when they're overpaying for deals with variable rate debt, what happened is, what made it pop was in 2021, the Fed has to raise rates because inflation's ripping, right? They're trying to help middle America, people who are getting crushed by inflation. And so they start to raise rates. And as they start to raise rates, all the folks who bought these deals at the peak of the market, which there was an incredible amount of transactions in 2020 and 2021 and early 2022 with variable rate debt, they lost control of their deals. So rates start climbing and their payments are going up 50, 100 grand a month. And nobody underwrites for that, right? You might have a rate cap in place that helps you a little bit, But once that rate cap runs out, now you got to buy a new rate cap for 500 grand or $1 million, and your values come down because as rates went up, cap rates, they followed and values came down. And so now you're underwater in these deals. So that's what happened when the Fed started to raise rates. And had there been more discipline from the syndication groups, from the investors to say this can't last, no, I'm not going to be buying with bridge debt, leverage to the max, variable rate debt, it would have kept pricing in multifamily down, and we wouldn't have seen so much pain. And that's the opportunity right now, is that's what we're buying. The sophisticated groups are excited about this time in the market. This is the most exciting time we've seen since 2012. And it's because the deals that got purchased in 21 and 20 and even early 22 with variable rate debt is now underwater, and people can't get out with positive cash flow. They can't get out with a gain, and they're forced to sell. And unfortunately, equity is being wiped, right? We're buying a deal right now, Plano, Texas, 229 units, B-class apartment, A location. Like, this location is the best location we've ever bought. We bought in 25 deals in our Granite Towers history. This is the best location we've ever bought. And we never would have been able to buy this location because of buyers that were buying like the person we're buying from right now. Most of what I just covered, people never hear from their financial advisor, not because it's a secret, but because most advisors don't think in terms of structure. They think in terms of returns. So I put together a free blueprint that walks through exactly how high earners are legally reducing their taxable by 15 to 20% using real estate, using the actual frameworks I use, the 3 tax buckets where your money is probably stuck right now, and what it looks like when you move it into the right structure. It's free, links in the description. A quote that I heard on podcasts, they're known, right? We all know each other. And I've heard them say, if you're using fixed debt, it's for pussies. And the piece I just think that should be heard in this moment is, yeah, equity's wiped, loan balance reduced, challenging deal, forced to sell. I don't think using fixed debt is for pussies. I just think it's wise. It protects your downside. Real estate, if we protect our downside, the upside takes care of itself. That's real estate. Think long-term, think 5, 7, 10 years. But that's the opportunity right now, is if you can get into a position where you can secure these locations that are A+ locations, you come in with low leverage debt, because right now, if you're buying a Fannie Mae and Freddie Mac, which is all we use, you get 5, 7, or 10 years fixed at 70% loan to value. You raise 100% of CapEx, you got freedom, you got a bunch of cash when you close, you clear the deferred maintenance, because there's a ton of deferred maintenance right now in these deals. By the way, you guys, if you are looking at deals, be so thorough with your investigation, with your due diligence, because what's happening as well is when these deals have bridge debt and their interest rates shot up and they're holding on for dear life for 5 years like people are, when that deal comes to market, all the cash flow that they had from the deal for those 5 years, they had to pump into the lender, to the debt. So now you're getting these assets, and the deferred maintenance is much steeper. And what happens is you have to get out, because A, the lender is telling you must sell, and B, if you don't fix the property, you're in this death spiral. It's a downward spiral. We've seen it time and time again. And so when you're doing due diligence, make sure you are super thorough. Do not trust the brokers, right? Use your vendors. Your vendors are on your team. Make sure they emphasize the importance of getting in and being detail oriented right now. Get in 100% of the units. Make dang sure you have enough capital, because when you close and you sign on that dotted line, the whole property is now yours. And you've got to be ready to hit the ground running to cure all that deferred maintenance, because you have to be competitive in the market. And of course, you're probably getting a big discount on price. I mean, the property right now we're buying is $6.5 million less, and that's not talking about their CapEx they invested to upgrade the property when they closed. That value add extra capital they put in is extra on top of the 6.5. But with that discount, you've got to be ready. You've got to be able to hit the ground running and start adding value and hit your business plan right out of the gate. And you now hold on for 5, 7, or 10 years and watch what will happen when this market comes back, because there's not a ton of supply coming. The supply that was started, the excess supply that was started when rates were really, really low and everyone was frenzying in, that came to the market 2 years later. That oversupply did not get absorbed quickly, and it brought rents down. And as rents came down, values came down, cap rates went up, values came down. And now you're in this period where there's not a lot of new supply coming. And if you get a 2-3 year window where there's not a lot of supply coming, you're buying at lower prices, 20 to 30% lower than back in 2021. It's 5 years later with NOI growth. By the way, you can have NOI growth and value sink, you guys, to not get too far into the weeds if your cap rate rises too much, which is exactly what happened. A lot of our NOI on our properties is stronger, but our values are down. It's because of interest rates, it's because of cap rates. And so it's this unique window for those that know what they're doing, for those that can attract capital, for those that have a great track record right now to be after some of the best deals we've seen since I started this back in 2012. The difference between multifamily and single family is it's a very different asset class. So from my perspective, with what we're looking at, like, I can't say that single family real estate is bottoming right now. It's a different asset class compared to us. What I'm purely speaking on right now is the commercial multifamily asset class. Are we at the bottom for single family if rates actually do start to come down? I don't know, because the part that's different now compared to back in 2008, 9, 10 is that we're in this unique position where everyone locked these extremely low rates. Right? Like, I'm sitting in my house here at 3.5%. So I'm not in a position where I need to sell. There's plenty of cash in the market. There's still enough, inflation where my payment's kind of small. And I think that's really a lot of people who locked in that really low fixed debt is because inflation, as it continues to rip, it makes your debt payment easier to pay off. So I don't necessarily think we're going to see a housing collapse. Could be wrong, but I don't see that coming because we're so short on supply. Incomes are still strong enough to pay for the low interest rates. And if there is some turn, if there is some flip, I think there's enough dry powder and enough dry capital where as they continue to print the dollar, enough people are waking up and saying, I don't want to have a ton of capital in my savings account. So single family, separate from what I'm talking about, but multifamily specifically, the opportunity is you can get into these deals right now where the data does not lie. The data is not shades of gray. We can see clearly with the data. CoStar, Archer AI, all these different data tools are telling us how much is coming. And we can see right now, without a doubt, there is not nearly as much supply coming, specifically in the multifamily space. And if you're in markets where you've got major job growth, major population growth like Dallas, you look at the U-Haul stat, #1 for 2 years of most single routes into Dallas. So without a doubt, out of all the places in the country, more people are going to Dallas because of that one stat. And so if you got a lot of growth, not a lot of supply to follow it, this is the opportunity to start investing. So you can get with us, you can get with other firms, you can get with people. Just make sure you know, like, and trust them. Make sure you understand that they have the track record and ability and team to get in and invest with them. And I'll tell you guys one thing I heard the other day, which absolutely blew me away. I was talking to our billionaire mentor, I had him on our podcast, and I said, what's the one thing you look for when you look to invest? He said, Dan, I look to see that they lost money. And I was absolutely stunned. I have never heard anyone else tell me that. He said, there's 2 reasons. #1, I'm looking for people that when things get tough, they don't quit. They learned. So didn't quit, figured it out, they learned. And with those lessons, I know that they're more evolved and they're more efficient. And I'll tell you guys right now, I can't tell you how many groups were here in 2021 and 2022 that they're gone. And I remember watching them. They're like, yeah, multifamily doesn't work. This asset class, it's not profitable anymore. And I would just pump the brakes and say, if the fundamentals are strong and we got more population growth, and by the way, far less people can purchase single family homes. If there is one thing that could crash the single family home market, that may be the thing, is that people just can't afford single family homes because they're just too expensive. If you look at the difference between what it costs to own a home versus rent, the gap is astronomical. When that gap gets too big, people are forced into renting. And I don't think it's a secret, we're heading to be a renter's nation. So the future of multifamily, from my perspective and my mentors, if you will, is extremely bullish. And the opportunity to be buying these incredibly located deals for very large discounts with awesome debt is right now. Right now, as everything is falling, this is where generational wealth is made. Not when it's easy, but when it's scary. But it's only scary if you're looking at the past to invest, not when you're looking at the data. And the data doesn't lie. This is a complete supply and demand game. And the lack of supply coming is going to put a lot of pressure on rents in markets. That pressure is going to make rents go up and values follow in great locations right now. You can sit on the sidelines and wait for things to feel safe again, but by the time it's safe again, the prices will be back up and the best opportunities will be gone. We are actively buying during this correction. And if you want to see the specific asset we're acquiring right now, check out this link below.